Let's talk about the models that have been used so far to value S corporations, and I'll refer to them generally as the cash flow based models. Regardless of which model the analyst uses, what the models are trying to accomplish is a comparison of the cash flow that reaches the pockets of the investor in a C corporation, and notably a public C corporation, compared to the cash flow that reaches the investor in an S corporation. Let me first say why a public C corporation. It's a public C corporation because what we're doing is we're adjusting for the differences between that which is embedded in the public market return and our S corporation. So let's start with where the tax court has taken this. And I want to make sure I say the tax court and any other court has yet to be presented any evidence that would cause them to do anything different than what they've been doing. It's that evidence that our book is addressing. So in the tax court model, the two columns, the public C corporation column reflects a reduction of, let's say, 40% corporate income tax. The S corporation column reflects no income tax. If you have those two assumptions in your model, that results in a 67% premium for the S corporation. Very large premium. And wouldn't business owners be delighted to know that just by making an S election, they could increase the value of their company by 67%? Alas, as analysts, we know this is not true. So valuation analysts came along and they took the analysis one step further. They said not only do public C corporations pay income tax, but their investors also have to pay dividend and capital gains taxes. So in the public C column, you have the deduction of, let's say, 40% for income tax and 20% for dividend and capital gains taxes. Now in the S corporation column, we recognize as analysts that taxes do affect value. And so we deduct the taxes on corporate income that is borne by S corporation investors. This comparison now gets us to a 25% premium. So the S Corp valuation models that were designed by various valuation analysts accomplished a great deal. They got us from the 67% premium to a 25% premium. And in fact, that model has been embraced by the Delaware Chancery Courts and some divorce courts, most notably in Massachusetts and Minnesota. However, these models don't go far enough. The reason for that is because no one has stopped to ask the critical question: do investors in public markets actually pay 20% dividend and capital gains taxes? If you stop to consider the things that serve to moderate the amount of taxes that are borne by investors in the public market, like the fact that institutional investment has skyrocketed over the last 50 years, and many of those taxpayers are tax exempt. Also, firms and their investors take steps to reduce the taxes that we pay. We know this. We advise our clients of this all of the time. There's tax deferral opportunities for capital gains. Over time, as taxes have changed between dividend and capital gains rates, firms take steps to help their investors reduce their taxes. So the notion that all investors in the public market pay taxes at the statutory rate, which is the inherent assumption in the S Corp cash flow based models, is demonstrably false. And that is the evidence that we bring to bear in the book.